it seems to me, I mean, the second one is, when I heard at you, is what the UK economy in Europe is more and more an exception. I mean, obviously it has always been. But if you think about it this way, in the UK right now, there are more and more political uncertainties, while one of the key change in the rest of Europe since the starting of the year is that there are less and less political clouds. In the Netherlands, in France, in Germany, I mean, the far-right party is in a disarray. Okay, in Italy, the Five-Star Movement is leading in polls, but even if it wins the next election, whenever it happens, it's unlikely to be able to form a government. And I will go back to this, but even in the US, at this stage, of course, we have to remain cautious, but at this stage, the new US administrations barks but doesn't bite much. So all in all, what does that mean for the global economy? It's quite positive. I mean, for the first time since the 2008-09 crisis, most economists or most experts have revised up their GDP growth forecast. And since 2008-09, this is the first time it happens. And so it's in line with a small magnitude increase in global growth forecast, especially mainly driven by what's going on in Western Europe and in some emerging markets. Again, I will go back to this in a few minutes. The same for trade. If you look at it on the right, you see our forecast. There were a lot of fears, concerns in late last year regarding protectionism risks. And so far, no one of them has really materialized. So again, if you look at the glass half empty, you see we're still far away from pre-crisis levels, both in terms of growth and trade. If you look at it half full, you see it's better than it used to be last year. So it's a kind of a better outlook globally. And having said this, we're not living in a dream. Again, I'm not going to talk about the UK economy. At Coface, we think there are two big question marks in the months ahead, and they are the biggest possible ones because they are dealing with the top two economies in the world, the US and China. But again, one of the key messages is that for once, Western Europe is not one of them. So let's start with the good news. When you're in an environment of higher growth, let's say a recovery environment, obviously there are plenty of sectors that take profit from this environment. And the good news is that it mostly you see them on the right part of the slide. A lot of them are in the industry side. It's not really a surprise. Those type of sectors like automotive, metals, all durable goods sectors, you see them on the right, were the ones that suffered more than the other ones from the crisis. And now they are likely to benefit more than the other ones from the recovery process. So just to be more specific on this slide, this is the coefficient correlation between, on the one side, global growth, and on the other side, the added value by sector at global level. So when you're on the left and the score is negative, it means basically this is a counter-cyclical sector. And unsurprisingly, you will find sectors related to public spending, which are supposed to be higher in bad times, but on the other side, in good times, they benefit less from the recovery. And as I said, on the right part of the chart, you see sectors that are supposed to benefit quite a lot from the recovery. And in the middle, to make it a little bit simplistic, you see a lot of services sectors which are benefiting from a global recovery, but usually with a lag. So this is for the good news. So you see, we can be more optimistic globally on sectors relating to the industry, like the automotive one, like the metal, where perhaps the worst has been passed. And this is exactly what we see in the eurozone at the moment. Again, I mean, we are not expecting stellar growth in the eurozone, so no big surprise. But I think the key message, again, it's not very surprising, but is that there are less and less uncertainties at political level, but also at economic level. We think there are still plenty of space for catch-up because the recovery process has been quite late, has started quite late in the eurozone. You see it on the left. The unemployment rate is still has declined quite significantly, but it's still much higher than its historical level. So for businesses, it means to some extent it's positive because it means there is no wage pressure. On the other side, for households, I know Mario Draghi has talked about reflation yesterday, but with an oil price lower than $50, a spike in inflation is very unlikely in the months and in the quarters ahead in the eurozone. All the more since you see the chart on the left, unemployment is still much higher than its long-term historical level. So all in all, if you combine all of this, to me, it's a kind of a perfect mix for businesses in the eurozone, because on the one side, on the profit side, they are benefiting from low prices of inputs. They don't have to face with wage pressure. But on the other side, they also benefit from a quite higher demand because despite a low wage growth, I mean, the purchasing power of households will continue to increase in the eurozone because inflation will remain low. So it takes again a lot of sectors benefit from it. You see an example with construction in all eurozone countries on the right. And the outcome, you see it with our forecast regarding business insolvencies. So it's a very basic and simple statistical model based on our GDP growth forecast. And you see for all eurozone countries, we expect a further decline in business insolvencies this year. So this is only growth forecast. So for example, for the UK, we expect an increase, but it's from a low starting point. So again, we have also to control from this. So for example, we expect -2 in Germany, -3% in France, and even minus 10% in Italy in terms of business insolvencies. So as I said, it's a kind of a perfect mix for businesses in the eurozone. It's not exactly the same in the US. I know there have been a lot of hopes regarding a huge and massive fiscal investment plan since the election of Donald Trump. Since the beginning and since the election at Coface, we have kept saying that at some point in 2017, these hopes will be disappointed because it's very, very difficult. It's going to be very, very difficult to get an agreement among the members of the Republican Party. And we have had another confirmation yesterday with the Obamacare bill. I mean, this was supposed to be by far the easiest reform to pass by the Republican Party. And they are not managing to do it. So let's imagine what it's going to do when they start talking about this fiscal infrastructure plan and how to finance it. So just in a few words, it's unlikely to happen by the end of the year. And to me, I even think it's unlikely to happen even next year. I mean, perhaps there's going to be a small magnitude plan, but I think it will not have a huge and massive impact on GDP growth as it was widely expected a few months ago. And as you know, the problem is that if you forget just one moment what's going on at political level, if you look only at the economic cyclical development of the US economy, again, the slowdown has started. On the corporate side, profits are not as high as they used to be. They have been declining for quarters and quarters. So a lot of people are saying, yes, but it's not really bad news. It's only due to what's going on the oil sector. That's partly true. I mean, if you look at the detail, 50% of the decline in corporate profits are due to the oil sector. And it's likely to continue if you look at the oil price development, of course. But the other parts, the other 50%, it's related to other sectors. And it's very easy to understand. I mean, the recovery process in the US has started a long time ago now. And the labor market is very tight. Wage pressures are not as high as a lot were expected, but there are some wage pressures. So it's weighing on businesses. It's not a very pessimistic scenario, but it's just that at some point the catch-up process is over and corporate profits start to slow, and in that case investment will slow and GDP growth is slowing as well. So that's why we keep with our below consensus scenario on the US. The IMF, you saw perhaps yesterday, the IMF downgraded its forecast on the US yesterday for 2017 and 2018. And again, we are not expecting a recession this year or next year, but we have to keep in mind private consumption will not be as good as it used to be over the past years in the US. This is a kind of a cyclical, a normal cyclical process. So all these macro views are reflected in these sector risk assessments. So we do it by looking at all financial data that are released by all listed companies all around the world. We also take into account, of course, our payment experience at Coface and the qualitative views of our underwriters. And when we combine all of this, we get a 4-grade scale. And obviously, when it's in green, it means the risk is low, and when it's in deep red, it means the credit risk for corporates in these sectors of a given region is higher. So you see the some cells in green, meaning that we have upgraded some sectors recently. And you see it's in line with what I said on the industry and pro-cyclical sectors. And they are dealing with some emerging market regions. And again, this is another key message of my presentation. We think for emerging markets as a whole, the worst has been passed. We expect a slightly higher growth this year in the emerging world. Having said this, another key point is that, of course, as you know, the situation is very different from one country to another. There are 2 countries where, despite pending political uncertainties, we expect a brighter growth outlook this year and next year. And they are the ones you see on this chart. They are Brazil and Russia. So obviously, those 2 economies are very different from each other. But in both cases, I mean, a lot of macroeconomic problems were related to the lower currency. And now their currencies have reappreciated quite significantly last year. So one of the key effects is that inflation has slowed a lot. For example, in Russia, we went to 16% inflation, and now it's lower than, it's close to 4%. It's even lower, it's closer to 3% in Brazil. So all in all, it helps households in both cases to consume more. So again, I'm repeating myself, but in sectors related to private consumption like automotive or the agro-food sectors, the outlook is a bit better than it used to be in those 2 countries. So having said this, I'm not saying we expect growth to recover their pre-crisis levels in these 2 countries, but at least growth will be positive this year. So again, we have to remain cautious because, as you know, if you look at the news in those 2 countries, there are still plenty of political uncertainties. International sanctions have not been lifted in Russia. Yesterday and the day before, you saw what's going on in Brazil with there could be another impeachment process in the months ahead. But again, even if we stay cautious, we have to say that it looks like there is a kind of a political fatigue in those 2 countries, in the sense that these political uncertainties have less and less impacts on these economies. And that's why we are now also a little bit more positive than we used to be. So these are good illustrations of the positive trends on emerging markets at the moment. Having said this, we're still also quite cautious because we think, especially for corporates in emerging markets, there are still plenty of risks. One of them is not new, but it's still an up-to-date one, a hot one, is related to corporate debt. And its impact on the banking sectors in a lot of emerging markets. So, you know, corporate debt in emerging markets has increased more than fourfold over the past 10 years. So it's huge. And the problem is that we see more and more signs of weaknesses in more and more banking sectors in more and more emerging markets. So you see on the left bad loans, which are increasing in a lot of countries. And the outcome, the second round effect, is that in some cases, we see more and more signs that banks are tightening their credit conditions in some emerging markets. And you see it on the left with the results, the answers of a quarterly survey which is made by the Institute of International Finance. So what you have to look at is that when the score is below 50, it means that banks are saying that they are tightening their credit conditions in the given region. When it's above 50, they're saying they're easing their credit conditions. So Central and Eastern Europe is an exception, but except this region, in all other ones, you see banks are saying they're tightening their credit conditions. And so I know growth is now higher than it used to be in emerging markets, so it's pretty good for businesses. But on the other side, in a lot of cases, we see more and more signs of a vicious cycle between, on the one side, a higher corporate debt, and on the other one, banks that are more and more in trouble and start to tighten their credit conditions, which is affecting, again, businesses which are over-indebted. So in this case, in this type of risk, I mean, China, of course, is a big one. Corporate debt in China is by far the largest one in the emerging world. So there are different ways to look at this topic. At Coface, we make a survey on a yearly basis where we ask a number of questions to about 1,000 businesses. And in the last one that were released in late March, the outcome were worse than the previous one, which were already quite bad. So you see it on the left. More and more businesses are saying they have to face with longer overdues. So how to read it? On the left, it means that on average, last year, more than 15% of businesses were saying that the average overdue they have to face is longer than 150 days. So the year before, they were only 10% to report this type of average overdue, and the year even before, 5%. And you see the breakdown on a sector-by-sector basis on the right. Last year we could say, okay, it's only a problem for sectors like construction, metals, and so on. But in this case, it's more and more spread in the world economy. So this is really something to have in mind. I know if you look at the news, it looks like GDP growth in China has stabilized since mid last year. But beyond that, at the micro level, we see more and more signs that the situation is not stabilizing at all. And that's the reason why, by the way, Chinese authorities have started since April to tighten a bit the monetary policy, and that's the reason why you start to see some signs of growth softening in China. So something to monitor. So if we combine all of this, you get our country risk assessment. Again, like for sector risk assessment, their goal is to try to take a look at the credit risk for corporates in a given country by taking into account our payment experience at Coface, and then, of course, a large range of financial and macroeconomic indicators. So if you look at the good news, since the starting of the year, because we update these assessments on a quarterly basis, since the starting of the year, we have decided much more upgrades than downgrades. And this is the first time since 2014, because in 15 and 16, at every quarter, we decided much more downgrades than upgrades. So that's for the good news. The negative one is that you still see a lot of red in the map, meaning that, of course, the level of risk is still elevated, very high in a lot of countries and in a lot of regions. Having said this, you have to keep in mind that this assessment is a short-term one, is a short-term risk assessment for credit risk. So, of course, it means that there is a lot of risk in the short term for a lot of businesses in a lot of countries. But nonetheless, you also know that in a lot of cases, when there is high risk, there is also some high yield. And if we look beyond 2018, of course, even though there is a lot of risk in emerging markets, the emerging market growth story, it doesn't mean the emerging market growth story is over. And there are still plenty of potential in a lot of regions and in a lot of sectors. So there are various ways to illustrate it. And here we have looked at the top 20 sectors, potential sectors in the next 5 years in a lot of countries. And so I'm not going to, of course, to comment all of them, but it's just an illustration that even though there is a lot of risk for businesses in the short term, there is also a lot of potential in the medium term in a lot of emerging markets and in a lot of sectors for a lot of UK businesses. So I start here, and I think we can start the discussion. Thank you.